So, what if I told you the old economy is about to make a major comeback? That is the bold prediction for 2026 from geomacro strategist Marco Papaggi. And honestly, it goes against a lot of what we've come to expect. We're going to break down the huge political and economic forces he sees driving this shift and, what it could mean for some really key sectors. Let's get right into it.
I love this quote because it just perfectly captures the vibe of this whole forecast. 2026? Yeah, it's probably going to be a white-knuckle ride. It's going to be volatile. But the point is, it's not predicted to be the year everything comes crashing down. So if we're not heading for a total disaster, what exactly does the year have in store for us?
Okay, so before we jump into the actual predictions, it's super important we're all on the same page about how we get there. This isn't about trying to pick the next hot stock. Nope. This is a top-down view that connects all the dots between what's happening in global politics and these huge market-moving trends.
So you might be wondering, what on earth is a geomacro strategist? Well, think of them as an expert who looks at how massive geopolitical events, we're talking international relations, domestic policy, even elections, end up influencing the big stuff, like the S&P 500, the dollar, and oil. The whole idea is, if you can get these big picture calls right, the smaller pieces of the puzzle just start to fall into place.
And this right here is the absolute key. It is not just about hearing a prediction. It's about understanding the story, the logic behind it. That's the real value here, seeing how global events could lead to very specific outcomes in certain sectors.
All right, now that we get the approach, let's dive into the first huge call, a major comeback for the energy sector. After a pretty tough 2025, the forecast is pointing to a big turnaround, and it's all being driven by a massive shift in global priorities. This slide really highlights a crucial change in strategy. See, in 2025, the story was basically Saudi Arabia helping the U.S. fight inflation by keeping the oil taps wide open. But in 2026, the script completely flips. Their own domestic needs take center stage. They have these huge nation-building projects they need to pay for, their cash reserves are getting lower, so they simply need higher oil prices. We're talking likely back in that $70 to $75 range.
Now, this brings us to a really fascinating paradox, and it's one that catches a lot of investors off guard. How is it possible that a president who's all for high energy production could actually be bad for energy stocks? Let's take a closer look. It really just boils down to simple supply and demand. A drill baby drill policy that floods the market with oil? That's great for all of us at the gas pump for sure, but it absolutely crushes the profit margins for energy companies. And history kind of backs this up. We've seen that administrations pushing for max production have often overseen periods of underperformance for the energy sector, while those with more restrictive policies have seen the sector do really well, simply because prices were higher.
Okay, now let's switch gears. We're going to shift our focus from the global energy markets to a really critical issue right here at home: housing. The argument here is that there is a powerful political incentive to get this market back on its feet, and fast.
Let's be real, the affordability crisis isn't about the price of a toaster oven. It's about the insane cost of the cornerstone of the American dream, owning a home. And when that feels out of reach for millions of people, it stops being just an economic problem. It becomes a political crisis. And a political crisis demands a political solution.
So because it's such a political hot potato, the forecast predicts this clear chain reaction. The administration declares a housing emergency, which puts pressure on the Fed to lower borrowing costs. That, in turn, gets mortgage rates to finally dip below that magic 6% number. And the result? All that pent-up demand from buyers who've been sitting on the sidelines gets unleashed.
So who wins if housing gets a lifeline? Well, home builders are the obvious one, right? But think bigger. Consumer discretionary stocks. People are going to be buying new couches, new appliances, all that stuff. And another key winner, financials. A big surge in mortgage lending is going to be great for their bottom line.
And for the financials, there's another powerful tailwind here, something called a steepening yield curve. When short-term rates fall faster than long-term rates, well, that's just a dream scenario for banks. It means they can borrow money really cheaply and then lend it out at much higher rates for things like mortgages. That difference, that's pure profit. Okay, time for a bonus idea, but this is a really crucial piece of the 2026 puzzle, especially if you're a U.S. investor. It's all about looking beyond our own borders and understanding the massive impact of a weakening U.S. dollar. Whoa, okay, just check this out for a second. In 2025, investors here in the US were celebrating a pretty great nearly 20% return in the S&P 500, but they might have totally missed that European stocks soared by a whopping 35%. I mean, what is behind that huge difference?
The answer is actually pretty simple. A 10% drop in the US dollar. Think about it. Even if a foreign stock's price stays completely flat, a US investor can make a 10% return just from the currency's move alone. It's this powerful and, honestly, often overlooked force in the market.
And the forecast is for this trend to keep going. With massive government spending not really in the cards, the Fed is going to have to do all the heavy lifting to boost the U.S. economy. And what does that mean? It means rate cuts, which could put even more downward pressure on the dollar, making those foreign assets look even more attractive. So, we've got a story for energy, a story for housing, and a story for the dollar. What happens when you put it all together for the main U.S. market index, the S&P 500?
The central theme for the whole year is this idea of market broadening. What that means is we can expect market leadership to finally expand beyond that handful of tech giants that have just dominated for so long. The old economy sectors, like energy and financials, are really poised to step back into the spotlight.
The specific target is 7,500. Now, that's a pretty modest single-digit return from current levels, which implies something really important. It is going to be a bumpy ride. It suggests that the gains we see from these old economy sectors will probably be happening while those tech megacaps, the ones that have led for a decade, struggle to keep up.
The year is expected to have a really distinct rhythm to it, almost like a tale of two halves. The first half is likely going to be pretty challenging and volatile, as the market just waits around for some policy clarity. The real pivot point comes around the middle of the year, and that sets the stage for a much stronger second half as all those stimulus measures finally start to kick in. So to quickly recap the absolute key takeaways here, we've got energy, set for a comeback thanks to geopolitics. We've got housing, with a potential revival because of a political push. We have a continued opportunity abroad thanks to a weaker dollar. And for the S&P 500, a volatile year, with most of the gains probably packed into the second half.
And that really leaves us with one final crucial question to think about. If market broadening is truly the theme of 2026, what does that mean for a portfolio that has been built on a decade of nothing but tech sector dominance?
And that is our deep dive into the 2026 market forecast. Thanks so much for watching.